Okay, so Mr. Phil, let's get to find the stated income loan. What is that? So,
Well, let me back up just a little bit, Don, because I know I talked to you about this a few weeks back, letting you know that I've been getting solicited in my stated income loans. People soliciting lenders that they're offering the program again, and this more so this year. Now, prior to this, we haven't seen this since '07, '08, at that last real estate market explosion that we had. It didn't exist. And I know that because I'm on a 1099, and I'll define a little bit more about that. But anyway, my point is that I say, wow, we're seeing this this past year, stated income back. Now, what is stated income? Well, stated income, by definition, is you're qualified by you stating your income. I know that sounds oversimplified, but that's really what it is. But let me give you a little rundown of a typical stated income loan, what it is. No tax returns, no business license, no CPA letter, no bank statements for income.
wow.
Now, this particular one that was solicited to me is for income property, for investment properties, for commercial property. And this would require that it's non-owner occupied, multifamily and commercial, and maximum LTV, which means loan to value, is 70%, which means you would have to come up with at least 30% cash down payment. But the minimum FICO score on this is 650.
That's pretty low.
It's very low. And again, we're going back up to qualifying, because normally on the loan, you need tax returns, right, Don? You need bank statements, right, Don?
Yeah.
On this one, you don't.
Yeah.
And you're just going to be stating your income.
And even though we give them a tax return, sometimes I get a letter from the people saying, "Can you send me a letter that you prepared the tax return?"
You see?
Yeah. And also that tax return, when you do that loan, excuse me, you have to sign a report that IRS can check your tax return.
Exactly.
I mean, that they can check IRS's tax return.
Because we know that in the past, and I don't know if it still goes on, we know a lot of business owners had a couple of sets of books, didn't they?
Yeah.
Right? They had one for the IRS, and perhaps they had another one for buying a house or selling their business, and they say, "Oh, I'm making $1 million."
Well, let's be a little bit more fair about that with these business owners. As a typical example, a business owner may have $100,000 in income from running his truck.
Mm-hmm.
Well, he's allowed to take $45 a day for being on the road, plus hotel rooms and $105 depending on where he's at.
Mm-hmm.
Right? We talked about it's gone up to $51 this year,
yeah,
as of October the 1st. So anyway, his real income is like $40,000, but when I take his tax advantages, he's down to $20,000. That makes a difference on what he can report on his Schedule C, on his front of his tax return.
Okay.
He needs that stated income.
Well, okay.
And he hasn't cheated. That's the way the tax law works.
Well, when I'm referring to those books, I'm talking more in a
I know
communities where it's a cash business.
Yeah, yeah.
And where what you're talking about, there's a paper trail, and they have documentation for everything.
Yeah, but even so, when it comes down to it, the loan guys just say, "No, sorry, the front of your tax return says this."
Right.
And now you don't have to look at the front of the tax return; you can use stated income.
Well, okay. So the reason I was bringing this is to piggyback off what we talked about the last time and the opportunities that are out there for people buying income properties to supplement their income with passive cash flow, where we talked the last time about the great FHA programs that are available, which are fully documented. You got to have all your tax returns.
Yeah.
But now, let me ask you this, Don. Are there people out there that have maybe side jobs or maybe making some extra cash or perhaps starting a business on the side that this would apply to, that they could take advantage of, so they can buy perhaps a little rental property to start their investment portfolio?
The answer is that yes, if you're a W-2 person, all your gross income is going to show on the top line.
Okay.
If you're a businessman, all your net income is going to show on the middle line. And so there's a big difference between a W-2 and a 1099.
Sure.
So it's really difficult for a 1099 person, whether he's got one job or 20 jobs. It's really hard for him to be able to show the loan company that he's really making the money that he can afford to buy the house.
Right, because with a 1099, if you're self-employed or a business person, you want to take advantage of all the tax benefits, right?
Yeah.
And so at the end of the day, perhaps that income isn't where it needs to be to qualify traditionally.
Exactly.
Now, some of the downsides of this, because there are some downsides, is, of course, the interest rates. The interest rates are going to be probably anywhere from 7 to 8%.
Yeah, that's what I thought was disappointing. That they're always talking 2.5 and 3.25 on the radio, and now you're saying that but these state loans are going to cost you more.
But yes, they're going to.
Now
cost
I'm going
more.
to say, but obviously, buying a house has always been a dream of everybody, and so this way they can accomplish their dream, I guess.
Well,
so you have to pay a little bit more for it. So
they're going to pay a little bit more, but this again is not their primary residence. In the context that I was looking at.
In context, yeah.
It's an investment income. It's getting that rental house or a duplex or a quad.
Right.
That's what this was. I was looking at this at because that wouldn't make sense if you're going to buy your first house. You should be able to qualify, and if you don't, there's a problem there.
There's a lot of good programs out there.
There's a lot of good programs out there for those and again, so interest rates are going to be pricey here. Now, an advantage to this would be this is a 30-year fully amortized loan. So it's not a balloon in here. Now, you know what the balloon payments are, right?
That's what killed a lot of people.
That's what kills a lot of people at the end of the day. Yeah, it could be a 3-year, 5-year, 7-year balloon.
Yeah.
These are fully amortized just like you would a traditional loan, okay? Now, the theory behind that, of course, would be perhaps interest rates will come down or you're going to be in a better position that you can refi down the road. And if that interest rate is still a little bit too pricey, you can perhaps deal with it at the end of the day.
That's true.
Now, the other side of this coin would be this is exactly how it was sold back in 10, 12, 13 years ago. And this is how a lot of people, this is how perhaps a lot of the economy got into trouble with the real estate bubble, because we were being sold that even though you cannot afford to buy this home, let's not worry about it. Let's just get a stated income loan, the one that you can just state your income. You don't need tax returns. And perhaps you're going to be in a negative situation and upside down for a year or two, but when the market comes back up again, well, refi was a conforming loan and you'll be back in the driver's seat. Well, we know that didn't happen in 07.
That's right.
The market tumbled along with the rest of the economy, and this is where we're probably getting to the end of all that foreclosures that piled up in 07 and the last 5-6 years because of a lot of these stated income loans.
Well, but that's what we're afraid of. It could happen again to us.
I'm wondering, because I know we talked a little bit about this, about the Dodd-Frank bill,
right.
And that was the explanation when we were looking for these a few years ago for business people, and they said, no, the Dodd-Frank bill says we can't do this.
Yeah.
Now, I got to confess, I'm not very up to speed with that bill, but apparently something happened between now and then where this is coming back on the scene because, again, I'm getting solicited from lenders practically on a daily basis that these loans are out there and they want to sell them.
Well, if somebody can tell us what happened to the Dodd-Frank bill, we'd both like to know, because I saw on the Hillary debate that they talked about it went away, and they were thinking that it was because the hedge funds people somehow paid the politicians off. I don't know, so that's what. But I heard the same that you did, Phil, that the Dodd-Frank bill wasn't as effective as it used to be. So.
Well, I brought also the second cousin to the stated income is the hard money. And I know we talked a little bit about that. That never went away because the hard money loan is not regulated as the other loans are. And let me understand this. So if I have 20% of my savings account,
but I need 30% to buy a rental house.
Okay.
I can go and get hard money for the rest of it?
No. That's a different ball game. But again,
So where's the hard money come in?
Okay, hard money comes in where let me go through a definition of a hard money loan.
Okay.
It's going to be a non-owner occupied, which means it's going to be either a commercial or an investment property.
Right.
You cannot occupy it.
Okay.
So, for examples, it could be apartment building, office buildings, car washes, businesses. They can close in as little as 7 days. No credit requirements. No income verification. Sounds like a stated, huh? However, the loans are going to be starting typical rate 8-9% all the way up to 15%, and you're going to have to come in with 40 to 50% down. So the loan to value is going to be much more higher. So the property itself is going to be qualifying for the loan, not you, the individual. They know that if this loan goes under, if this property goes under, they're going to be able to swoop down right away and sell this even below market and recover their
yeah, but I'm
their
still
loan.
lost. Where did the hard money come in?
It comes in. I'm sorry. What's the question?
The question was, you said hard money. You were going to tell me about using hard money to buy a house, to buy a property.
Yeah, not a primary, but this is a secondary. This is an investment property.
Right.
That's the context that we're talking in.
Yeah.
That if you have horrible credit, because remember to state it, you got to have at least 650 or above,
yeah, right.
which is pretty decent, right?
Yeah, right.
But with hard money, credit's not an issue.
Oh, okay.
Period. Credit's not an issue. Taxes are not an issue. Well, I don't know about taxes are not an issue, but the thing that's qualifying for the loan with hard money is the property itself, because the individual, the borrower, is coming in with 40 to 50% up front.
Does it have to be his money, or can he be getting it from somebody else? So that's what I'm trying to understand. Hard money.
Well,
hard money to me means those guys on the street that say, "I'll loan you, but you pay me back 25%."
It's close to that. I know I don't know what the usury law is, but maybe 21, 22%. But right here, what I don't think they're going to verify where the money's coming from.
Okay.
Okay. So the money again. The property is qualifying for the loan,
Gotcha.
and as long as the property is a value that you're stating,
right,
the lender is gonna be coming in as your equity partner.
Yeah, exactly.
Okay, and so hard money in some circles is considered like a cash purchase. I know when I sold a property in East Los Angeles that was condemned by the city. We had investors coming in with either cash or hard money, and I had a lot of problem with the hard money borrowers or purchasers that wanted to buy this property, because they were telling me that their offer was the same as cash, but I didn't see it that way, because something still had to qualify, as opposed to someone who actually had cash out of their pocket for the whole property.
Right.
And that's what I was looking at, and I got some people very angry at me because I didn't accept their hard money offer, and they asked me why. I said, because the property still has to qualify. Where the guy coming in with cash, he's coming in with cash with no contingencies.
Right.
Where you're telling me that you have to the property has to qualify. This guy's telling me nothing has to qualify. I'm giving you cash for the loan.
Right.
For the property straight out.
Yeah.
So they looked at it as it's the same as the guy with cash. I didn't see it that way, but the investor saw it that way. I don't know. But that's hard money. But again, going back to stated, Don, this is a great opportunity for those who want to come in. Let me ask you this, because prior to this, they said that they needed a letter from the CPA if you had a 1099. What does that letter consist of? What did that borrower need to get from you to get that stated income prior to this, where we don't even need that anymore? What was it that they needed from you?
Well, later basically said that when you send a letter off to the mortgage company saying, I prepared a tax return for this client, you just say, to the best of my knowledge, that there is no errors. And that's what you put on that letter.
So that's what they had. Well,
to the best of my knowledge.
The only thing that this doesn't have that I saw prior to 2008 is that this is really nice, again, for business owners and for people on 1099, doctors, dentists, barbers, people that get 1099s
Yeah.
like this. It's great. But what this doesn't have that the prior stated incomes had was they had what they call a power option loan tied to these. Now, do you know what that was?
No, I never heard of that one.
Yeah, the power option loans that were tied to these loans where you had a choice of 4 payments every month to make. And what was nice about those, and they worked very well up to the real estate bust, was every month you had 4 choices on which payment you're going to make. You're going to make a negative amortized, an interest only, and an amortized. In other words, you had 4 different payments to make on that loan.
Yeah.
Choices. Now, what was good about that, let's say you have a business that's seasonal.
Yes.
You know, like maybe...
Taxes.
What's that?
Taxes.
There you go.
Seasonal.
Perfect.
Yeah.
So it's either feast or famine, right?
Well, it's not famine, but it's feast.
Well, you have
yeah.
good months and bad months.
Yes, right.
Right? Okay, so on the lean months, that would probably be your minimum payment, right? And on the good months, you pay the highest payment, okay? And that's was the power option loan. But when these were tied to those previous stated income loans, with those what I would call, and excuse me, but liar loans.
I like that term, liar loans.
Well, yeah, because people were buying houses they could not afford.
Yeah.
And so when every month came, which loan do you think they were picking? The highest payment or the lowest?
Lowest.
And the lowest payment was a negative amortized loan.
Right.
And so they felt this can go on indefinitely, but obviously it didn't. Well, I'm not seeing that yet, but I'll be very surprised if I see power option loans coming back on the scene again with this, because if it does, then this is the exact same thing we had prior to that real estate bust.
What's the difference between that, what you just stated, and just refinancing your house when the value of the house goes up?
What's the
That
difference?
You're doing a negative on the house, right?
No, no.
your
Why would you be?
So
No,
negative means your principal is going up every month.
no. Negative amortized loan means you're not even paying the principal. You're not even paying the interest or the principal.
Okay, so
you're tacking onto the loan
the interest.
which you owe, right?
Yeah.
Right.
So it's going up every year.
It's going up
every month. Right.
Exactly.
Okay, but then what you do is you refinance a house, and so that negative is taken care of in the new refinance.
If the home appreciates.
Yeah, if the home appreciates, exactly.
Right. And
So
if
what's-
you're in a positive position, yeah.
Yeah, so the power loan would be okay in that case.
If it was, yeah, if they were still available in that case, yeah.
Yeah, right.
But again, they abused that power loan option. Okay.
When houses weren't going up, they think they were going down.
Well, they were going up up to around 7 or 8 when the big financial bubble hit,
Yeah,
right?
exactly.
And then when everything went down,
Yeah.
we weren't expecting that because
Yeah.
this is what was driving this. That the appreciation was unrealistic. I mean, properties were going up.
30%.
Yeah.
Yeah.
So people were saying, well, this can go indefinitely,
Yeah,
right?
right.
Well, obviously it didn't. The bubble did burst. But up to that point, this was working for a lot of people, and it was being good because they would refi. It was basically an ATM.
Yeah,
Okay.
that's right. It was an ATM. Yeah.
But it was abused because this had been around for years, and business people, 1099 people, used to use it. And again, going back to the way it was meant to be, on the lean months they were paying the minimum, and on the good months they were paying the maximum. So it balanced out, and it worked for them.
Right.
But I haven't seen the power options come back into the market yet. So, like I say, I'm very surprised to see this stated. So if the power options come back on the scene, I don't know what we're headed for, Don.
Well, you brought up a good point, and we're not economists, but we're also simple thinking people that realize, like you just said, you can't keep printing money.
You can't.
Okay, and so that's the one thing we see, and then we see that the people are getting into homes that maybe they can't afford because of lessening the restriction on home buying,
Right.
right? And we all see that, also feel like, and I'm and I had some direct experience right now, not direct, but my clients I want to talk about, that the people aren't getting the jobs that are supposedly out there, so our economy is not growing like it is.
Mm-hmm.
Obviously, China's been lying about what their economy is doing because they're cutting off. There was an interesting story that another country, a small country, has been sending them all their iron to make steel, and China cut their purchase of that country by 50%.
Mm-hmm.
So now this country is in big financial problems because it was depending on China to buy all its iron ore from it. We're seeing all these things happen, right?
Yeah.
And immigration in the foreign countries. Who's going to pay for those immigrants going into those foreign countries? They say, "Oh, we're going to hire them." That you can't hire those people right off the bat, you know,
Right.
because the skills they need. I don't think those people have those skills. They can learn them, but they can't. They don't have them now. So all this stuff we're listening to and saying it doesn't make sense of our economy is going to go big. And you've got the same question. You get the same question that my client yesterday sold her home, and her real estate lady told her, take your money that you're getting from the sale of your home and put it under your mattress.
Yeah.
And you're getting the same question from your client saying, where do I put this money that it's safe?
Well, Don.
So we're talking about something that we don't know, but we're saying as sane people, you know, how close are we to having another bubble?
Well, I agree with everything you said, and it doesn't look good. I'm telling you, the on the horizon economically, and this is where I think, in my opinion, that for those who can should take advantage and be more self-sufficient and not have to depend on the government or their jobs. We don't know how long those jobs are going to be around. We don't know how secure our jobs are going to be, and this is, I think, taking the direction of a little bit more self-sufficiency and being more independent by having income property, because people have to live. People need a house to live in, an apartment to live. They need a roof over their heads, right? Now, while things are still pretty relatively good and these opportunities are around, people are taking advantage of it, and I'm thinking that more people should be taking advantage of it. Interests are good. There's properties out there that people can buy. And I'm looking at this right here, this stated income. There's really no excuse to take advantage of the opportunities that are out there.
Well, you gave us the big secret last time we met was about using, instead of buying a single home resident that you may not qualify, buying a 4-unit or 2-unit and using the income, the gross income from the unit, the rental unit, to qualify for your income.
Absolutely.
So it's the opportunities are there right now.
The people that I've seen over the past 25 years in real estate, and probably longer than that, I'm sure, that own mega apartment buildings and making a tremendous amount of money every year, started with a little single duplex or a single home, and they just multiplied.
Yeah.
And they took advantage of, we talked about 1031 already,
Yes.
the exchanges. They take advantage of the tax laws, because there's tremendous tax advantages to owning real estate, correct?
Yeah, absolutely.
And they took advantage of financing and
Yeah.
leveraging
Yeah.
other people's money.
Right.
And this is just a classic leveraging other people's money, taking advantage of the tax laws, and being independent and not depending on that job.
Well, like you just said, I said 7% or 8% is too much for interest rates compared to what you hear on the news. No, if you can get a positive cash flow with 8%, do it, right?
Absolutely. And with rents going up, they're not going down.
Yeah. That's the other thing that all the economists are saying, that in 20 years everybody will be in apartments, or and you see that in Japan already, that people are in like little rooms in Japan. They're not in big houses in Japan. Because there's not enough land, but B, because that's how they're living now. They're not depending on their entertainment to come from their home. They're finding their entertainment someplace else.
Well, Don, I'm going to state directly right now that I'm a political atheist. I told you that before.
I love that word.
But we're getting all these legal or illegal immigrants coming into our country.
Yes.
They got to live somewhere.
They got to live somewhere, yeah.
and there's only more and more coming. It's not less and less.
Yeah.
And so this is where I see opportunity here, wherever you're at. And again, we're talking about there's great financing programs out there. There is a supply of properties out there. You have tax benefits because our taxes going up or down.
Taxes won't go down.
You see?
Now, and people keep thinking that they're going to fix the tax law. I have that video I did on the reasons why tax laws are the way they are in our country today, and there's just no way you're going to get that law changed. There will be obviously talking by the different congressmen and senators and presidential candidates to fix the tax law, but in reality, the middle class is always going to be paying the majority of the taxes. I just had it happen on Wednesday. I had a poor lady that's I call her poor. I have a nurse that's making over $90,000 a year. She couldn't get the tax credit for a kid going to college. You know, that's one of those things we talk about, the middle class not being able to. And you know, she is middle class. She's not in the high bracket, you know.
So think about it. You see here for someone like that, and that sounds like a typical person now, right?
Yeah.
I mean, 80, 90,000 used to be a lot of money. Now
It's not.
It's not.
Yeah.
But now what's killing her also is those taxes, right?
Yeah.
Because at the end of the day, how much money does she have spendable income
Yeah,
anymore?
exactly. Yeah, no, her taxes are killing her.
So let's say, for
I won't
example,
say killing her, but yeah, her spendable income is not what it looks like at $90,000. Yeah.
so I don't know what her living condition is, but let's say someone like that had a little duplex. They lived in one, they rented the other. They have income coming in. They have tax advantages. They have all these. You see where I'm getting at?
You know what? I'm going to tell you the human side of that story.
Go ahead.
The human side of that story, and I hope I'm not telling too much on this client. But it's, you know, I have a lot of nurses, so you're going to have to figure out which one it is. But so you won't figure it out. But this nurse though has three children, two boys and a girl. So the girl is going to college, right? And she can't write off her college expenses because she makes too much money.
Okay.
Right? And the one son is doing okay. He's got a job now. But the third son is a security guard. Guess what's going to happen? They're going to say, "Hey, Mom, you got that empty duplex. Can I move in with you?"
Well, all right. Yeah. Well,
so what
that
you
goes.
need is tough love, and I don't know if you're going to get that. But I'm just saying, there's the danger of what you just suggested.
Absolutely, no doubt about that. But real quickly to cap this off, I was so curious. Why are so many benefits, tax benefits, tied to real estate? And a very, very successful investor said because the government wants people to invest in real estate for housing benefits. They want them to invest because people need housing.
Yes.
And so they're giving these advantages, just like right now, not only on the horizon, but right now the tax benefits are going to environmental businesses, right?
Right.
And so we've seen all these tax credits going to them. We're seeing all these tax benefits. I think some people, I've heard it said that there's more money in green than drugs now for some people, you know. And so anyway, getting back, traditionally it's always been the government's idea that they wanted to give incentives for people to buy income property because people need to live under a roof. And most of the politicians are heavily invested in real estate. And if you look at most of the wealthy people, that I love to read biographies on wealthy people, they're most of the time tied to real estate. Mm-hmm. And again, we're talking again because of appreciation. Properties usually go up in value. We're talking about passive income and a big one, tax benefits.
Yes. Yeah.
So why not copy and take advantage of what these people are doing, whether it's at a big or small scale, Don?
I think your point is totally taken. That if you want to become secure in your retirement in your old age, that the how do I want to say it? That the way to increase your wealth and to make yourself secure is to have real estate. And like you just stated, if you have property and there's people's got to live somewhere, so they're going to need to rent from you.
Yeah, and start small. Start
Yeah.
with a little something
Right.
you can manage.
Yeah.
Because someone once said, "Well, how much risk can I take?" And I think the best definition I heard is, if you can sleep at night, you can take it. If you can't, you got too much risk.
That's the best way to put it.
Yeah.
Yeah, because it's not for everybody. But
Exactly.
That's true. Yeah. And then the other thing, though, is that even if we don't have appreciation in a place, your renter is making your principal and interest payment for you.
Right.
So your value in that property is going, your equity in that property is going up every month just by paying down the mortgage.
Well,
So
good
you
point.
are getting a retirement plan.
Good point, Don. And right now, I can't recall the terminology, but there was mortgage to rent ratios that were outrageously negative up to 07, 08. Because again, the value of properties was way overstated, but now it's turning around,
Yeah.
and interest rates are great.
Yeah.
So the mortgage to rent ratios are back where they should be, either on a flat wash or positive. Because if you got to do your research, and you definitely don't want to
Gotta
get
do your
something
homework. Yeah.
that's not going to put you in a negative,
Right.
because you don't want to do that.
Right.
Because people in the past were saying, yeah, go into negative, so you can get your it's a loss, and
Right.
you can
Get your
benefit
tax
from the
write-off,
tax.
yeah.
But that's not what
That's
income
right.
property is. You want income coming in.
That's right.
So do your research and
Yeah.
make sure you're at least in a positive situation, and if not, I'd walk away. But there's a lot of opportunity to get into positive, whether it's $1 or more. You should be in a positive situation as far as the income's coming in. If
Absolutely.
not, then I don't think it's a good deal.
Okay. Well, they can get further information from Phil by calling 626-590-8653. It's on the screen. I'm going to repeat it one more time, 626-590-8653. Obviously, Phil has the information and the qualities to help you in your next purchase
Please call.
or your sale, for
Yeah.
that matter, too.